in just 1 quarter. That is nuts. So what is going on at the Bank of Montreal? The IMF is warning of a major mortgage default event that could unfold in Canada, and that Canada has the highest risk among developed countries in the OECD. And not only that, you've got other things that are going on, like a potential banking crisis, and Canada is most at risk and exposed to this. So Canadian mortgage default risk is the highest in the OECD, according to the IMF. The days of Canada having a reputation of conservative bank practices are coming to an end. Yeah, no shit on that. In a new research note from the IMF, the global financial agency ranked mortgage default risk for households. Canada's combination of high household debt, frothy home prices, and floating rate loans makes it the riskiest advanced economy in the world. And don't we really know what's going on there? We understand it on this channel, and I'm going to show you how the households are being destroyed right now. Executives at Costco are warning of a recession, and we know how many loans these banks have extended, and we're going to take a look at that as well. So let's take a look at what the IMF did. So basically they ranked from lowest risk to highest risk, and you can see that Canada and Australia, Luxembourg, Norway, Sweden are all ranking very, very high on that list there. So Canada is not in a good place at all, and you know, it's going to be incredibly interesting to see what happens. Higher rates have been a buzzkill for the global housing frenzy. What the heck happened? Global real estate prices surged in 2020, the IMF attributing it to low rates and tight supplies. Low rates expand credit service capacity and incentivize borrowing, leading to the explosion of investors and over-leveraged home buyers. It's not a fringe theory, but one the BIS, the central bank of central bank, also agrees with. And we've gone through that before. And what's incredibly interesting about this is even they, when they're talking about the global housing market, are talking about tight supply. So it goes to show that tight supply isn't just a problem here in Canada, it's a problem globally, and I've seen it true. It's true of expat areas that are in huge bubbles in Mexico. It's true of places in the United States too that are all struggling. So this whole immigration narrative is just totally stupid when it comes to these things. You have to remember that when you have prices rise, and they rise really fast, people don't sell because they're happy. They're happy seeing their home price appreciate, so they're just going to go, we'll hold off selling, we'll sell another time, which leads to the tight supply. And then you have the denial, and it's not until you eventually get to that fear phase that you see all the supply unravel, and that will likely happen through an economic recession. As interest rates began to normalize and stimulus was removed, home prices pulled back. Just lowering the incentive to borrow and throttling leverage was enough to pull back home prices. And you know what? If you look at 2008 as an example in Canada versus the United States, during the interest rate tightening cycle in the United States, home prices went down around 13%. And that's really interesting because Canadian home prices during the same period, they didn't do anything. And when 2008 hit, home prices only went down around 8%, whereas in the US, they went down 32% in that 08 recession. But now you have the complete flip of that, in the sense that Canadian home prices during this tightening cycle have gone down even more than the US did during 2008, during that tightening cycle. They've gone down over 20% versus the 13% in the US. So that just goes to show how extremely volatile this is going to be. And even the bull trap then is going to be even more volatile. So you'll see even higher prices in that bull trap because you've just got more emotion in that market. And we 100% see that here in Canada. Extremely emotional markets when it comes to home prices. Let's just quickly talk about this. So Costco executives warning of looming recession because of one change shoppers are making to their buying habits. So they're basically just changing and opting for cheaper products. But what's really interesting is they mention the lipstick effect here, which is really interesting because it's something a commenter of this channel actually commented about a while ago. I went and looked it up. We've talked about it in videos before, and now they're actually saying that that might be unfolding, which is really indicative of what's about to happen. What is the lipstick effect? I'll just quickly define it for you in case you don't know. The lipstick effect is when consumers still spend money on small indulgences during recessions, economic downturns, or when they personally have little cash. They do not have the cash to spend on big ticket luxury items like boats and RVs like they did in 2020. However, many still find the cash for purchases of small luxury items such as premium lipstick. For this reason, companies that benefit from the lipstick effect tend to be resilient even during economic downturns. So that's essentially what the lipstick effect is. And then we've also got this which is going on, which is not good at all if you really think about it. 1 in 6 Canadians say they are likely to default on a major loan as rate hikes pinch. Now, this was released in February, but do you think that's gotten better or worse from now on? So I don't think it's got better by any stretch of the imagination. And with all these warnings that we keep seeing come out from places like the IMF, the BIS, even the banks themselves coming out, which is kind of hilarious and talking about it, it's really funny to see what's coming to fruition now, because you are going to see those defaults. If you actually think about it, even if there was a mass default event that was going on right now, we wouldn't necessarily know about it because it takes a long time for that to actually come out in the statistics. Especially the default statistics here in Canada are insanely laggy, and that means the data that places like the Bank of Canada is getting as well are really laggy too. So they're always going to be behind the curve on this. They've just gone from one mistake to another. It's just absolutely insane. They created the bubble and then they're going to also pop the bubble as well. And this is always the case with central banks. It's almost like it was planned or orchestrated, which it may have well been. So let's take a look at those banks and just see the insanity that has been going on with loans. So loans in the last quarter, just to show you what's been going on with the banks, absolutely insane. Especially with the Bank of Montreal has just seen a huge spike in the past quarter earnings that they just reported in loans. They've seen loans nearly 100 billion extra loan growth. That is crazy. That's like nearly 20% or over 20% of loan growth in just one quarter. That is nuts. So what is going on at the Bank of Montreal? Anything like this, we've got to be a little bit cautious and say, what's going on there? We also know that the Bank of Montreal operates in China. Of course. So, you know, how exposed are they to the real estate crisis that is still going on in China? You know, there's still a major real estate crisis that's going on in China, another real estate bubble. These bubbles just can't pop, everybody says, and they do in the end. It's just kind of funny. But anyway, so interesting what's going on at BMO. Bank of Nova Scotia, they saw their loans increase from 759 billion to 776 billion. You know, that is probably like a normal increase that you would expect, which really just shows you how extreme the BMO increase has been, and it's not trending with some of the other banks, which doesn't make any sense. So it is a red flag. Is there something going on at BMO that we don't know about? Because that does stand out to me. So if you look at the CIBC, you can see here that they again just had a slight increase. I say a slight increase, but it's still $8 billion. It's still a lot of money when you really think about it. And these numbers are just insane. Like, we're already over $1 trillion and we've only talked about 3 banks in Canada. So this just goes to show how much debt is outstanding right now and how well equipped is the consumer to deal with that debt. I'm going to show you at the end of this video, and it's not good, as we know on this channel. So anyway, Canadian CIBC, I keep trying to say the Canadian Imperial Bank of Commerce, but nobody calls it that. And then you've also got the Royal Bank of Canada here, which again, it's seen barely any growth, 8 billion as well in loan growth for the last quarter. So nothing really of note that looks like it's going on there. And it would be interesting if you actually saw this decline as well. That would be another thing worth noting, because that would be a sign that credit is tightening. And even the loan growth slowing is sort of a sign that credit is tightening. So what is going on at the Bank of Montreal? That is a question that we got to ask, because that is just insane, guys, that loan growth. All right, let's continue on here. So TD Bank, again, it went up from 862 to 877. Pretty similar and in line to all the other banks. And that's the thing, guys. How are all the other banks? They've got pretty similar loan growth. And then BMO has just got like 20% loan growth in a quarter. What the fuck is going on at BMO? Like, is it something to do do with China? Are they just having a mass default event? We know that BMO is extremely exposed to derivatives, that's for sure. So National Bank of Canada also, let's take a look at them. So they went from 204 billion to 210, in line with all the other banks. And then you've got the EQ Bank. We've also got that. I thought I'd throw that up there because it's interesting. You know, they're pretty much flat for their loan growth, which I found interesting because you would expect that credit tightening would happen among the weaker players, or not the weaker players, like I should say it like that, or just the smaller banks first, like EQ Bank, which isn't as big, obviously, as the big five in Canada. So that's really interesting. So yeah, that's what's going on there. And then if we take a look at the consumer's ability to service their debt and what's happened to their income over the past 26 years, it's not good, guys. It's not good at all. If you look at this chart, this is adjusted for the 1980 CPI. I've been through many times why I adjusted it for the 1980 CPI versus the CP line now. I'm not going to bore you with that again. Go to prior videos if you want to see why. Essentially, you can see here, this is inflation as in the 1980 CPI, and then the wage growth is the yellow line at the bottom here. And where I've got the magnifying glass, that is 0% wage growth in real terms, adjusted for inflation. So you can see that only after massive stimulus has that line ever crossed over 0%. So in 2009, it was at 0.75%. And then in 2020, when we had the massive stimulus boom, it was at 1.23%. If you look at all the negative real wage growth, what has happened here? And then just look how this tanked down here all the way to minus 12%, minus 7.47% in 2021 and 2022. So this is just an absolute nightmare for the consumer. The consumer's ability to service their debt has just gone off a cliff. And us, you and me here at the channel, we can realize right now that, hey, these consumers, their ability to take on debt is coming to an end. Like, it is coming to an end. That's obvious. Just look at the negative amortization and everything that's happening there. We got rising defaults. We got rising corporate bankruptcies. We got credit card debt rising. We got credit card debt defaults. We got the banks warning of defaults. I mean, do you want any more red flags? We've got growth slowing. I mean, if it was adjusted for the real CPI like this, we'd already be in a recession. I mean, they mess around with all the fucking numbers. It's so annoying. It's just so corrupt. It's so frustrating. But anyway, you can see what's going on with the consumer, and it is not good. The consumer is in a terrible position to service their debt, and their debt is at record levels, as we saw from the banks charts. So this is not a good thing at all. It's a serious issue. So anyway, if you've enjoyed this video, you might like this video here. You might also like this playlist here, and I will see you in the next one, guys. Take care of yourselves.